What if I told you the warning signs of the next real estate crash are already flashing right here in the Pacific Northwest? I just got off the phone with a client who asked me something that honestly kept me up last night. Hey everyone, I'm Matt Jolivet, licensed mortgage broker with over 25 years of experience working with buyers across Oregon, Washington, and Idaho. I've seen the 2000s dot-com bubble, the 2008 crash, the COVID boom, and everything in between. And right now, I'm seeing warning signs that remind me way too much of patterns from the past. Now, my client asked me, should I wait to buy? It feels like the market's about to crash. And today, I'm going to give you the unfiltered truth about what I'm seeing in our Pacific Northwest markets. No sugarcoating, no clickbait, just real data from someone who lives and breathes this stuff every day. Here's what we're covering today. The specific warning signals I'm tracking right now in Portland, Seattle, and our surrounding markets. The potential triggers that could actually cause a real correction. And most importantly, how you can position yourself smart, whether you're buying, selling, or just waiting to see what happens. Lucky for you, with me being licensed in the Northwest, I get to see all the ins and outs of what's happening in our region and in a real-time basis. So let's dive in. Section 1, current warning signals. All right, let's talk about what I'm actually seeing on the ground. And I gotta tell you, the data's pretty eye-opening. Interest rate reality check. First up, interest rates. We're sitting in the high 6% to low 7% range as of this recording. And that's cutting our buyer pool literally in half. A $500,000 home that costs $2,100 monthly in 2021 with 3% rates. Today, at 6.875%, you're looking at $3,300 a month. That's $1,200 more every single month. I had a couple back in 2022 when rates were at the all-time lows who got pre-approved for $500,000. By the time they found a house they loved, their buying power had dropped to $425,000 because rates jumped 3 points. It's brutal out there, and the numbers show it. Seattle's King County sales dropped 2.6% year over year. Oregon statewide home sales fell 4.6% compared to last year. It's not massive drops, but it's a clear shift from the frenzy we saw just a couple of years ago. Supply and demand flip. For the first time in years, inventory is building up. In Seattle and Portland, homes are sitting 30 plus days instead of the 10 we just got used to. Just last month, I was helping a couple who was looking at properties in Beaverton. 2 years ago, houses there would have had 15 offers in the first weekend. The one they looked at had been on the market for 3 weeks with 0 offers. And 20% of listings now have had price reductions. Buyer behavior shift. Remember those crazy bidding wars where people waived inspections, threw cash at everything? Gone. My borrowers are getting inspection contingencies again and asking for price reductions instead of paying $50,000 over asking prices. It's actually nice to lend in a normal real estate market again, if I'm being honest. Section 2, what could trigger a real correction? So those are the warning signs, but what could actually push us over the edge into a real correction? Economic triggers. If unemployment jumps significantly above 5% and stays there, we're at 4.2% right now. That's historically when we start seeing people struggle with mortgage payments, not just avoiding buying homes. We've already seen tech layoffs hitting Seattle and Portland hard. Amazon, Microsoft, Nike. When tech workers lose their $200,000 jobs, those $800,000 plus houses start looking really expensive. Plus, if inflation stays stubborn, we could see rates climb back to the 7% plus range for the next year or two, a regional risk. For years, we've had people fleeing California, moving up here, but that migration is slowing big time. Remote work policies are changing. Oregon and Washington keep raising taxes on what government officials believe to be high-income earners, and that number keeps shrinking. And our homeless and crime issues in the cities are making people choose suburbs over urban cores, which shifts where the demand is. All of that was fuel for our market to grow. Take it away, and prices start looking inflated. Financial system concerns. Our regional banks are loaded with commercial real estate loans, office buildings, retail spaces that are struggling. Look, if those banks have problems, credit gets tighter. I'm already seeing some of this with my lending partners. Section 3, smart positioning strategies. All right, Enough doom and gloom. Let's talk about what you can actually do with this information. The consensus among experts, including myself, is that we've likely topped out on rates this cycle. We should see gradual easing throughout 2025. Forecasts have us in the mid 6% range by the end of the year. Maybe high fives if everything goes perfectly, but don't expect dramatic swings. If you're thinking about buying, fall and winter 2025 could be your sweet spot. Look for distressed or motivated sellers, divorces, job relocations, estate sales. Keep your finances bulletproof with emergency funds, stable income, excellent credit. I had a client who waited through 2022 and 2023, kept renting, kept saving. She just bought a house in Tigard, Oregon for $75,000 less than it would have cost 2 years ago. Consider emerging markets before they rebound. Maybe Renton instead of Seattle, or Wilsonville instead of Portland, if you currently own. Don't panic if you're staying 5+ years. But avoid cash out refinances at the 7% range when you probably have a 3% mortgage. Focus on improvements that add real value and build that emergency fund. If you need to sell, look, you gotta be realistic about pricing. Expect 60 to 90 days on the market instead of 10. Offer buyer incentives like permanent rate buydowns or temporary rate buydowns or closing cost credits. Consider rent back arrangements. Investment strategy. If you're thinking about real estate investing, cash is king. Focus on properties that cash flow from day one. Diversify beyond real estate. Stocks, bonds, maybe some commodity exposure. Or for those who can stomach a little bit of risk, maybe some small crypto exposure like Bitcoin. Look, here's the bottom line. Could we see a market correction in the Pacific Northwest? Absolutely, but a correction doesn't mean a crash. Even if we see prices drop 5 to 10%, that just gets us back to more normal levels. Stay strategic instead of emotional. Don't make decisions based on fear or FOMO. Every market cycle creates opportunities for those who stay patient, keep their finances strong, and act when the timing is right. So what are you seeing in your local market? Are you positioning to buy, sell, or wait it out? Drop a comment below. I read every single one and respond. If you're in Oregon, Washington, or Idaho and want help developing a personalized strategy for developing these potential market changes, click the link in my bio for a no-cost strategy consultation. Hit that subscribe button and turn on notifications. Market conditions are always changing and changing fast, and I'm pretty sure you don't want to miss any of my updates. Thanks for watching, and I'll see you on the next video. Stay smart out there.